We have various priorities in our investment allocation. Every year we change this allocation, these priorities according to our investor demand. For example, this year we have at least 3 priorities. One is opportunistic credit, one is asset-based lending, and the third one is secondaries. Why this? Because since we started investing in private credit, we invested a lot in direct lending because we were following this shift from liquid to illiquid credit. Now that we have become much more, let me say, skilled and educated on private credit, and we have built a very diversified portfolio of direct lending, which is the core of our portfolio, we are shifting up in terms of risk-return profile, investing in opportunistic credit, and diversification, investing in asset-based lending. And third, we want to leverage this new trend of secondaries. Opportunistic credit, why? Because there are still a lot of interesting opportunities looking for idiosyncratic risk in specific areas of the market. And we think that we are able to look for managers, because we work in fund selection, we run a fund of fund, looking for this type of specific opportunities. Similarly in asset-based lending. Asset-based lending is the new trend. We have been able to invest in some of these initiatives tactically, receivables, shippings, aviation, and now we are looking at this more strategically for a long-term allocation in our portfolio. And finally also on secondaries. The question is always, what can stop private credit? Because we have seen, COVID, so a shock we have seen interest rates increasing. We have seen macro political challenges, and private credit is always growing. So as an investor, we always think, what can really hinder this growth? We don't know. Simply we know. We still really carefully assess where the trend is going. For example, we are seeing an important sophistication of the level of the investors. Also ourselves, from a simple direct lending investor, we are now moving to credit ops and asset-based lending. Similarly, many other type of investors, like retails, wealth management network, are entering into this space. So you are seeing managers offering, semi-liquid funds, evergreen funds. So the market is developing, and the menu of the products that an investor can choose is much wider. I think that in terms of due diligence, we all are quite boring as LP, because we always ask the same question. But the parameters, the drivers of this analysis are always the same. So we really look carefully at origination. How much is this firepower, this scalability of the manager that we select? Second point is obviously the underwriting capability, the execution capability. So it's important to see the numbers, so the track record, but also it's important to see the people, and is connected to the third point, the restructuring capability in the case that something goes south in the exposures. So this is really driven by the quality of the people, the experience of the people. So we really assess carefully the professionals and all the infrastructure of the asset manager we select. If you go down and deep dive into the numbers, what we are really careful at having, a background as an insurance investor is the cash-driven metrics. So not only the final net IRR, but also the cash yield and the final DPI of the fund. As an LP, initially we thought about secondary just as a way to sell funds. But we are now changing our mind. We assess very well the market, which is growing, because the private credit is going north of 1.6 trillion. Private credit secondary is going north of 30 billion of flows. So we really believe that there is space for an LP to leverage the trend and start investing in secondaries. So we will be active investing in secondaries very soon. And we really believe that this is beneficial for our portfolio for various reasons. For sure, the alpha versus primary, thanks to the discount, the diversification, because you can invest in a lot of exposure altogether. And finally, also the limited duration, the mitigation of the J curve in the building of the portfolio. So finally, we believe that secondary is moving from a tactical trend to a very strategic long-term growth.